Hello, everyone, and welcome to the Holland Knight CPA webinar series. Thank you for taking the time to join us today as we discuss some recent tax legislative updates. We have a little housekeeping before we get started. Everyone is muted, so if you have any questions during the presentation, please type them into the chat box. We have placed the CLE request form link in the chat box, and we will also read out the code about halfway through the presentation. We will answer questions as we go, and we will hopefully have time for a Q&A at the end. Please reach out to myself or any of our speakers if you would like to receive the recording or any materials from today's presentation. So without further ado, I'm going to hand it over to Nicole for a brief introduction of our panelists.
Hi, everyone. Thanks so much for joining us. We are here today to provide you with a tax legislative update. My name again is Nicole Elliott. I'm joined by my colleagues, Todd Wooten and Josh Odintz. Together, we have years of experience with the government, not only on Capitol Hill, but in Treasury and IRS. And these are issues, what is happening on the Hill with tax is definitely on our minds on any given day. We are also part, I should note, part of a bigger group at Holland Knight. We sit in the Public Policy and Regulation Group, which is a group of approximately 160 professionals working on all sorts of issues, not only tax, both again on the Hill and in government generally. So our agenda today is to kind of provide you with a complete picture of what's going on in Washington, D.C., both with respect to what's happened recently, what we're expecting to happen in the final months of 2023, focusing also on expiring tax provisions and talking about this kind of giant cliff that is facing us at the end of 2025 with various tax provisions expiring. And finally, to talk about what's kind of going on in the international stage, and how that impacts what we do here domestically with our tax code. As Sarah mentioned, we're gonna do this in a Q&A type of format. So I encourage you to drop in your questions in the chat box, and I'll monitor them and post them to my colleagues as we go along. We intend this to be very interactive, and we're happy to try to answer any questions that you may have. So on the first thing, we kind of wanted to talk about what's happened recently that sets the stage for the upcoming months. And unless you were not reading the news or reading the newspaper, we had a debt ceiling limit issue. Let's just leave it at that. And a lot of us were on edge about what the United States and whether Congress would act in response to reaching that debt ceiling limit. Todd, I wanted to just set the stage again to talk about what's happened recently on Congress and how did we avoid defaulting on all of our debts, and kind of what kind of taste has that left on Capitol Hill in terms of being able to proactively work together in the future on tax or other things.
Sure. Well, first, I would just like to thank everyone for being here. We really appreciate it. These are always kind of fun to do, particularly on things like this. So I would say that with the debt ceiling, the initial feeling whenever it passed was probably cautious optimism. Seeing bipartisanship like that on a major bill on something with profound significance was a little touch and go for a bit. And so to see both sides come together, to see the really strong votes, particularly on the House side, I think there was a fleeting moment whenever people were like, wow, maybe this can really work. Possibly, there are bigger things which are just around the corner. Then for anyone who's been paying attention, the House pretty quickly kind of devolved again. The margins are so narrow, as most folks know, that it doesn't take many House members kind of deciding that they want to bring the place to a halt to be able to do just that. And pretty quickly, you had some people who are quite conservative saying that they felt that the debt ceiling deal did not get enough and things like that, and bringing the House to a halt. That does not bode well for kind of future bipartisan legislation, things like that. So while initially people felt good, I think that dissipated pretty quickly. But it's obviously wonderful that it happened.
And to be clear, there was not any tax included in that debt ceiling limit.
That's right. There were no tax provisions, which was sort of a win for Dems, because initially, that was proposed that potentially you could roll back credits from the Inflation Reduction Act, particularly within the space with energy, things like that. None of that was included. So from a Dem perspective, you could consider that a win. The other thing that was kind of interesting there was those credits are broad. And there will be facilities, other things that will go into red districts as a result of the tax credits, which were in the IRA. So what was somewhat heartening, I think, for people who support renewable energy, carbon capture, things like that, was that you had Republican House members saying to their leadership, hey, you can't roll back some of these credits. Like I have companies which are coming into my district, which are going to put jobs there. I didn't vote for this thing, the IRA. I didn't like the process by which the IRA was put together, but it's going to bring jobs to my district. And if you start rolling this back, that's a bad thing. So overall, I would say that the process was helpful to a degree in terms of protecting the IRA credits going forward. Now, what you did have, obviously, were the provisions which relate to more funding for the IRS for enforcement, which is no small deal. But a lot of that was pushed towards the out years. So it will kind of be interesting to see like the overall effect of what those cuts actually are.
Josh, did you want to add something about the debt ceiling deal and its implication, if any?
Yeah, I'll just say, look, the IRS, if any of you are dealing with the IRS, you know that the line to get the phone lines require hours of being on hold, even on the practitioner hotline. So any cut to IRS funding is, I think, troublesome. And yes, it is mostly in the out years, but there will be behavioral changes, because instead of getting $80 billion, the IRS will get $59 billion over the budget window. And so the IRS really is running behind from a technological standpoint, from customer service, from an audit perspective. So I think it's not helpful, even if all of the money that's cut is going to go into customer service or wherever it's going to be cut from. I do think we want a well-funded IRS that can meet its mission.
Excellent. And so now that we have, thankfully, the debt ceiling limit issue behind us, at least temporarily, what other kind of must-dos are outside of tax have to happen this year in Congress that might take the attention away from the tax provisions that we're about to talk about?
Sure. So you have, obviously, the big one is the defense authorization bill, which Congress always passes, and which in recent years you've had things possibly tag along with. We can kind of cover that a little bit later as to whether or not a big tax bill could be married with that. You do have to fund the government. I will say that today that's looking a little bit trickier than perhaps it was even on Monday, as a result of the deal that Speaker McCarthy had to cut with those conservatives that I mentioned earlier, to be able to get the House working again. They will write appropriations bills in the House to, I believe, 2022 levels. And that will be very difficult, and it will be very hard to reconcile those bills with the bills that will come out of the Senate, which will not be written to those levels. And so funding the government when we get to September, that will be probably a little bit tricky. Also looking at a bill on China. Senator Schumer has been very open about this. A lot of that would probably start with things which were left on the cutting room floor, from CHIPS, USICA, other bills that Senator Schumer has kind of put forward in that vein, but they would by no means be limited to those things. It's possible you could have more things come in kind of on China. Future of the workforce is something else, which is very big for Senator Schumer. I think that's still kind of taking shape. And then you have kind of odds and ends like the FAA that has to be reauthorized. There is a tax component to that from the standpoint of the user fees go through the finance committee. So it's possible that you could see other things added there. Although, as I was talking to someone about earlier, you have to pass the FAA bill. You do have to reauthorize it. And so you can't get too crazy in terms of the things that you would want to add to it. But those are the major things that I think folks are looking at as we head towards the end of the year.
So all of those are pretty significant issues. Could take some air out of the room, as they say, for the things that we need to do on tax, particularly given the recently expired or expiring provisions. So let's talk about the year-end package. Josh, what do we need to get done? What's the likelihood? And can you talk about recent events, such as the bill that was introduced or that was released, the America Families and Jobs Act? On the next slide, please.
Yep, absolutely. So, unfortunately, Congress did not finish its business at the end of last year. There are several provisions that really matter to business that either became worse or were not extended. The three biggest areas are, first, Section 174, which is the deduction for research expenses. After 2021, instead of getting a current deduction, those expenses must be amortized over 5 years. 163J, our limitation on interest, was 30% of EBITDA, so taking into account depreciation and amortization, and went to 30% EBIT basically on January 1st, 2022. And then finally, this year, current expensing after 2022, current expensing is less favorable. 80% can be currently expensed of qualifying assets that are placed into service this year, but 20% must be depreciated under the normal depreciation rules. Those are probably the three biggest areas of items that expired or expiring for this year, and so those are included in the American Families and Jobs Act that's being marked up today in committee.
Can you talk a little bit more about, so the American Families and Jobs, the three provisions that you talked about are definitely, if they are expired or expiring, are definitely bad news for businesses, right? So as it relates to 174, 163J, and current expensing, before we jump in, I guess, into the markup and what's happening there, is there bipartisan support for those? Are they, why are they expiring? And kind of what's the feeling on the Hill around those three provisions?
So I'd say there's broad bipartisan bicameral support for 174. Everyone recognizes that over 80% of 174 expenses are basically payroll for research and researchers. So everyone wants to fix 174. There's a few things on the dynamic of that provision. Last year, there was an effort to fix 174. Democrats asked for some relief under the child tax credit, which was greatly expanded as part of President Biden's first bill on COVID relief, and there wasn't a deal to be had at the end of last year, unfortunately. So, but Democrats broadly support fixing 174. So do Republicans. I think Democrats are pointing out that this is a Republican timing gimmick as part of TCJA, and they're coming in to fix it. But I think they clearly want to fix it. 163J, there's also bipartisan support, less so than 174, because I think 174 is an easier issue to explain to members who just have a few minutes of time to listen. And then finally, on current expensing, I think there's still bipartisan support, but many view this as a Republican ask because it's also a Tax Cuts and Jobs Act provision. But I think all three will ride together as part of the negotiation at the end of the year.
And these, because they're pro-business, these cost money to extend, correct?
They all cost money. So in the case of research, it's under $10 billion. to extend it through 2025. 163J is in the 20 to 30 billion dollar range. I forgot what current expensing is, but basically, yes, they're all timing issues in some respects, and yes, they all cost revenue.
So can you tell us a little bit more about walk us back to recent, we've been hearing that there would be the release of this America Families and Jobs Act for a while now, I feel like. And we finally saw the text, and I believe it was kind of 3 separate bills. And they contain these provisions and fix the expiration, but there was other stuff in there too, right?
That concept will survive going forward. So it's electable for 2022. So that will, I think, address the issue.
And then the other question I have from the audience, I don't know if any of us have been following, is that the Opportunity Zone program, which came into effect many years ago now, probably 4, I'm guessing. But I know that the American Families and Jobs Act included some provisions to extend those tax benefits. Those were, that initial legislation was supported in a bipartisan fashion. So perhaps what, if anything survives, that could also be something that's has enough bipartisan support.
Yeah, and look, there are some very strong supporters of opportunity zones in the Senate, Senate Finance. This was Senator Scott from South Carolina, his major request as part of the Tax Cuts and Jobs Act. I think there's a lot of support for this provision to lead to investment in certain distressed zones. So I would expect this has a good chance of survival, whether it's now or in 2025. I think this provision will be a permanent feature of our code.
Correct. But to be clear, we're not saying collectively that the American Family Job and Jobs Act as a whole has a future, correct? So let's talk a little bit about what happens next, right? So these bills were released, and anyone can Google them and find them and see a section by section of what's included. What happens next, and what's the likelihood? Todd, do you know the procedure or the process that we're under right now?
Sure. I mean, at a basic level, they've got to mark up the bill, get it out of committee. I think that they'll probably do that. The interesting thing is within the last 24 hours, you've had a number of, again, people from the further right end of the spectrum, the Freedom Caucus, et cetera, who have pointed out that to them, it seems sort of at odds with just going through this debate on the debt ceiling and then passing a tax bill which would add to the deficit. This, in some ways, probably reflects the populist strain, which has taken hold in some quarters of the Republican Party. Whereas before, maybe you could count on folks to, support corporate tax breaks broadly because they believe you should just lower taxes, all those types of things, and that generated economic activity. Within the last few years, you have seen folks on the Republican side of the aisle really question whether or not corporations should be getting tax breaks for certain things. And so here, just because you're cutting taxes, it's not necessarily going to win the votes of everyone within the Republican Party. So that really threatens the bill's viability whenever they get to the House floor. It's possible that you might find some Democrats who were in relatively moderate districts, who were in districts perhaps that Trump won at some point, who would look at this and who could find some things in it that they wanted to support. That's possible. I wouldn't say it's likely. So therefore, if you have 10 Republicans who are going to oppose it, you can't put it on the floor. How that kind of relates to its overall viability is you put a lot more pressure on the Senate to act if the House is able to pass something. If the House is able to say, we have addressed tax issues this year, we've addressed them in a substantive way, all of these things that Josh was talking about that people want, that give them certainty, that allow them to invest, we have done our job. Senate, it's on you. that puts much more pressure on the Senate. If the House is unable to do that, I don't think that necessarily means that the Senate will do nothing. If you know anything about the chair of the Finance Committee, Senator Wyden, Senator Wyden likes to do things. He is active. He has developed a good relationship with Chairman Smith. A lot of folks don't realize that, but yes, they talk. They actually get along. I think that one thing that they have in common is they do both want to pass things. So I don't think that if the House is unable to get this bill off the floor, that will preclude the Senate from actually doing anything. But I do think that it probably lowers the pressure on them. If I had to bet, you will see some sort of effort to try and address many of the things that Josh was talking about by the end of the year. Whether or not that will be able to succeed, open question.
Excellent. Let's move. Josh, is there anything final words you want to say, or let's move on?
Yeah, I think if I were to look at the calendar, in a perfect world, 174 would be addressed before September 15th, when a lot of S corporations need to file their returns for 2022 and be able to claim 174 deductions. I think the S Corp community, those that do a lot of research, whether it's subcontract research for the government, et cetera, they really need to fix 174 as soon as possible. And they are out in force finding every member. And there's an S Corp in every single jurisdiction. But I agree with, I'm feeling confident something will get done. I can't tell you when it's going to be done, but I'm feeling pretty good that Congress will eventually get to a deal on tax extenders.
Very good. Next slide. And so I know we talked about quite a few, 174, 163J. Is there anything else that's kind of imminently expiring in 2023, whether or not it's included in this bill that is being marked up now, that we worry about or think about?
Yeah, so I can take that. I think the first and foremost are all the various airline taxes that fund the FAA. And as Todd mentioned, those taxes expire September 30. So there's a ticket tax, there are airline fuel taxes, there's a bundle of taxes that fund our aviation. They have expired once before that I can remember. So perhaps if Congress cannot act in a timely manner, they'll expire again. But we understand, for example, that there will be a markup soon at Ways and Means. There's a markup at another committee with jurisdiction on the non-tax provisions. So I do think Congress and the House is trying to move forward on reauthorization. And then in the near term, there are a whole host of incentives for renewable fuels and biodiesel that expire by the end of 2024. So there's obviously bipartisan, bicameral interest in those provisions. So Congress needs to do something. I unfortunately think because of they are not this year provisions, they might lag and go into 2024.
Right. And Todd, I mean, we're going to be in election season soon. I feel like it's imminent, or how does that kind of, if at all, impact, what could happen at the end of the year?
This is something which I've been doing this for about 20 years, and I feel like that you always hear this. You always hear, well, there's going to be this election, that everything's going to slow down. But my experience has always been that people end up working far later into the year of the election. Again, we're not even there yet. This is the off year. It's always been my experience that people end up working far later into that than folks realize. One of the things that I always point to, and I think it's actually really appropriate for this current election, if you look back at 2012, I believe that the Senate passed a farm bill. They voted on over 60 plus amendments, I think. And that was in May of 2012. So that's about halfway through the year. So whenever you're looking at action in 2023, I think folks will look to try and do quite a bit at the end of the year. The first hurdle to that, though, is going to be keeping the government open in September. So, maybe you shut the government down for a bit and perhaps, everybody gets that out of their system. And then they realize that, to the point that Josh is making, we can really help the economy, everything else by taking care of some stuff at the end of 2023. Then we can go to fighting in 2024. For me, again, I think that you will see action on some relatively significant bills, particularly in the early half of 2024. But we've got to get through funding the government. Then we get to whether or not you do something big in December of 2023. And then you all can all remind me that I was wrong whenever Congress does nothing for the entirety of 2024. But I don't think I will be, because usually they end up doing something.
Fine. So I'm going to give everyone the code now. I'm required to give you the code for your credit. That code, if you're paying attention, is HK 2306137445. Again, that code is HK 2306137445. So let's talk about this. Okay, we're in 2024. We better, I think, be preparing for the 2025 tax cliff. I'm sure there'll be a nifty name given to it at some point. On the next slide, and that one after, there are, as a result of the Tax Cuts and Jobs Act, a large amount of tax provisions that are expiring. And given the kind of significant work to negotiate these, I think the general feeling is we will be busy in 2024. But Josh, can you tell us about, kind of the cliff and what could what is expiring if we don't do anything?
Yes. And this is what every tax lawyer or tax professional dreams of, right? This instability that's coming. Couldn't have planned it better myself. But I just want to set the table before I get into the ugly details, why this happened. When one party runs the table in an election and then passes tax legislation through reconciliation, the party within the majority is limited by the reconciliation rules to a 10-year number, and then they have to solve for X for a 10-year budget window. And then they can't have any deficit spending outside the window. So what you see are a lot of timing gimmicks, like, for example, 163J, 174. We see current expensing getting less favorable. But also there are other features that are built in. And so what are those features in the system? Let's talk about the individual side, because that's really what's going to draw the attention of Congress. So first off, AMT comes roaring back for people earning under $1 million. So for those of you earning under $1 million, this is great. You don't have to calculate AMT. You're out. It comes back. At the same time, and I'm looking forward to that as living in a high tax jurisdiction, SALT comes back uncapped, which is great. But then you have to run AMT, which is a pain in the rear. The estate and gift tax unified exemption decreases by 50%. So going from roughly $20 million to $10 million exemption. And then 199 Cap A expires. And look, even though I do a lot of work with multinational businesses, small businesses are everywhere, and they will want 199 Cap A made permanent, and that's the deduction for pass-throughs. Then also the various exemptions and phase-outs, PEPs and Ps come back, and the individual rate increases by 2 percentage points. It goes up again to 39.6. So that is the perfect storm on the individual side. On the corporate side, and specifically the international side, the corporate rate we're fine at 21% for now. But the beat rate increases to 12%, 12.5%. The GILTI rate, global intangible low tax income rate, increases from roughly 13.25% to over 16%. And then the foreign derived intangible income, which is the export subsidy, that benefit also becomes less favorable. So that rate also goes up to, instead of 13 1/8, goes up to 16 and something percent. So those are fairly significant, provisions, and Congress will not allow individuals to pay all of those additional taxes. So I expect it will lead to significant discussion on the Hill in 2025.
Thanks, Josh. So it sounds like a lot of things are possibly changing or reverting because the Tax Cuts and Jobs Act was, had them doing so, and it really requires Congress to step in and change the trajectory. But I'm hearing kind of different things, both on the business and in the individual side, different things that different people might care about. And I'm wondering how, if these expire at the end of, December 31st, 2025, right? What is that? How does that kind of line up with elections? And, I know that there's only small margins right now in Congress, and how I would think it has everything to do with how this cliff is addressed. But Todd, wondering your thoughts on that.
Well, I mean, if Dems were able to hold the Senate, and if they were able to take back the House, and if they were able to keep the White House, then obviously you'd be in a very similar situation to where you were last Congress with the IRA and with other things, where reconciliation is on the table. And so therefore, as they look at this, they can kind of address it completely on their own. That's not ideal for any number of reasons, because of, as Josh noted, this is it at some point comes back around whenever everything expires. If Republicans, by the same token, run the table, take the presidency, take the Senate, then again, it would be very different. And we can all see that. I think probably the most likely electoral outcome, at least today, if we're talking about today, June 13th, 2023. It's a very tough map in the Senate for Dems. If elections were held today, Republicans probably take the Senate. It looks like Dems could possibly hold the House. So you might have something set up where people would have to work together. Personally, I think that would probably produce the best outcome. I think that's what would probably get you, this mix of really looking at the corporate provisions that you feel like have been effective and that have worked, and also the provisions on the personal side. But yeah, I mean, it's everything. I mean, the way that these big tax bills over the last, I guess, going back to 2017, 5-6 years have come together, have been when one party controls everything. So it would be more than a little bit interesting to see how that would play out if you actually had divided government.
If I could just, if I could add, Nicole, I mean, so if you look back to the Bush Jr. administration, if you recall, Congress passed 2 significant tax bills, AJCA, American Jobs Creation Act, and I forgot the other bill, that were passed using reconciliation. And so reconciliation has been used. There's a broad history of using reconciliation to pass tax bills. The problem is they're not stable. And if we're looking for stability in our tax system, really having split government will foster compromise, will lead to a bill that reflects the will of both parties, and hopefully will provide a more stable tax system.
So bipartisanism would be important for us so that we have stability and hopefully provisions that don't expire every few years. But, if we have one party running the table, as you say, this could be fixed through a reconciliation process. But again, we'd kind of be back to square one in that using that reconciliation process, which doesn't require bipartisan support, has its own kind of procedural issues in terms of what it can address.
Yeah, and it will certainly change the philosophy of the bill, right? So Republicans, if you look to what happened in 2017, that bill lost over $1.8 trillion of revenue within the window, the 10-year budget window, and that cost has gone up in looking back in the rearview mirror. If Democrats control the table, then I expect a bill that will raise revenue overall net. We saw that with the inflation, with the IRA, Inflation Reduction Act. We saw that with Build Back Better, which didn't catch fire and pass in Congress, but that bill was revenue neutral. So I'd expect Democrats to have a bill that makes harder choices as far as increasing some taxes to offset others, and it's probably a more progressive bill. And if Republicans run the table, it'll look very different. So this election is extremely consequential for the shape of tax policy in 2025. But I also think it's important, Nicole, to say the discussions have already begun on tax reform. Businesses are going in to meet with members on both sides of the aisle in both houses, because there are a lot of new members that came on to Ways and Means. A lot of key members retired. We have a new chairman. Former Chairman Brady retired and took with him a significant amount of knowledge on TCJA. So right now, businesses are going in to educate and to explain how certain pieces of the tax code affect them, but also to provide a broad-based education on what happened in 2017 and what needs to be addressed in 2025.
Oh, and I would just to kind of add to that, on the kind of other side of that, when you look at activity potential activity at the end of 2023, Dems have, as we talked about, they've been pretty open that the child tax credit and things like that, that's what they want addressed in exchange for whatever else you want to do over on the corporate side. I have had folks who have said to me that, in 2022, Chairman Wyden and Chairman Neal had conversations with members where they were saying, if we want something on the child tax credit, we have to accept that we may not be able to get everything that we may not be able to get everything that we want. People have pointed that out to me to say that Dems in 2023 might be in the same position. Personally, I think that that's not quite correct. I think that in 2022, the operating belief was that Dems would not have the Senate, that they would be in this position with a Republican House and Senate who were doing whatever they wanted to do. And so therefore, perhaps you needed to cut some type of deal on the child tax credit then, because you would not have been able to do anything now. And also, how this kind of relates to 2025 is if you're the Dems, and if what you're being offered on the child tax credit in exchange for corporate provisions, whatever else, isn't really to your liking, I think that there will be some thought of, do we want to cut this deal now in 2023? When we know coming in 2025 is the whole ballgame. This is when potentially we have really significant leverage. And so this is where, yes, everybody is thinking about these things right now. I mean, this is what is consuming the tax committees outside of their regular keep the trains running on time, keep the trains running on time type work, is all thinking about, this huge negotiation, which is just around the corner.
Awesome. So let's talk about our last subject, and then maybe we can get some questions generated. The international arena. And that's, Josh, where you are keeping your thumb on this. Like, what in the world is going on in the very understandable terms, if you will? And, how does that impact or not impact all of the things that we've been discussing for the last 45 minutes?
Yeah, so let's rewind the clock to 2011, when the OECD kicked off the BEPS process, base erosion and profit shifting process. And for those of you who paid attention or were following it, there were 15 action items, of which 14 of those items led to different products and work streams that were then implemented, or there were reports to finalize, and then that led to changes both in the United States and abroad. But then there was one action item, the taxation of the digital economy, that the United States pushed back, and there was broad disagreement between the United States and other countries, including France, who co-chaired the working party on how to address the digital economy. Then under the Trump administration, basically there was an agreement to move forward on a work stream on the digital economy, so BEPS 2.0, and that ultimately became the two-pillar solution for the digital economy. So we have pillar one, which is we may see an agreement this summer at the OECD on pillar one, which would effectively apply formulary apportionment and shift some of the income from the IP jurisdictions, intellectual property jurisdictions, to markets. So if you think about it, if the IP is held in the United States based on a formula, if a company is within scope, then some of those profits will be shifted over to market countries, think India, think China, et cetera, and then those countries will get to tax that income or that revenue. But the one that is front and center and everyone is really paying attention to is pillar two. And pillar two, the deal struck at the OECD requires every jurisdiction that is signed on to apply a 15% tax rate. And that 15% tax rate is based on a different measurement than what we're normally used to. It's based on adjusted financial statement income. So starting point is financial statements, and then various adjustments are made to then get to the revenue for purposes of computing the tax base and the covered taxes. The approach is a jurisdictional approach, so it's like CFC rules, but on a per jurisdiction basis. And so the European Union is committed to adopting these rules, as have at least 140 other countries across the globe. And right now, various countries are in the process of proposing legislation and implementing that legislation. The first year is effectively at the end of 2023. Countries are committed to applying the pillar two rules. There are a series of coordinated rules that I won't get into the details, but it's important to note that these coordination rules expose the ultimate parent jurisdiction of a group to taxation from other jurisdictions, and that is caused some concern in Congress.
So is the United States moving to make sure that it is meeting its commitment? Does it have a commitment to have a 15% tax rate under pillar two?
It depends on who you talk to, Nicole. So if you ask Chairman Smith, we've already implemented pillar two. We have GILTI, and we tax all the income across the globe. It's taxed at 13.125%, but that's close to 15%. So Chairman Smith would say we've done enough, and then also we have a domestic top-up tax, which was added in the Inflation Reduction Act, a 15% tax on book income. I think the administration would say, well, we don't really have, we've not fully complied with what's required of pillar two, and so in their Green Book proposal, which is the compendium of tax proposals in the budget, they would move GILTI to a country-by-country approach. They would adopt this top-up tax that applies to foreign parented groups, and so they would really go down the path of the same, effectively the same prescription from the OECD. So that's where the administration is. And what we saw in Build Back Better was a movement in that direction, which was country by country GILTI, and some modifications to the BEAT. But overall, we're still, so we're kind of at this loggerhead.
And if we don't follow suit, if we don't, or if others believe that we didn't meet our commitments under pillar two, I think it's those coordination rules that kind of kick in. Is that right, Josh? And make sure that other people, other countries then kind of get the benefit of it. I mean, it's a way to kind of get everyone to 15%, right?
Correct. And I think the biggest risk for multinationals is that it will end up with double taxation that won't be relieved. And I mean, that's clearly going to happen without coordination. If there is coordination, there is still the risk under the rules for double taxation, but the amount that's subject to double tax or triple or quadruple tax will decrease. So it really is, it's up to, if this is going to move forward, and certainly at this moment, it appears that the EU, Japan, Australia, South Korea, our big trading partners, are moving forward with Pillar 2. And so, yes, if we are incongruous, it will have negative consequences for multinationals.
So we have a great question, and people and participants, please add your questions because we're rounding out of what we wanted to address today, but certainly, again, are willing to take your questions. But the current question pending are any tax havens like Bermuda or the Cayman Islands anticipated? Are they going to implement Pillar 2 rules? And is there any anticipation that, whatever happens in kind of those who adopt or don't adopt Pillar 2 will offshore or, change where they're headquartered?
Yeah, so the rule that addresses inversions is called the undertax payment rule. I'm sorry, undertax profits rule, or UTPR. And that allows every subsidiary jurisdiction that participates to tax the parent jurisdiction. So if an entity migrates from a high tax jurisdiction to a zero or low tax jurisdiction, like an island, I won't specifically name a island jurisdiction, but if it moves to an island jurisdiction with no substance and no tax rate, then all the other countries get a chance to tax that parent and top it off to 15%. And there's a formula based on headcount and tangible personal property. That formula allows each country to get a cut of that top of tax. So that's designed to prevent inversions in the event Bermuda, Cayman Island, other jurisdictions don't implement Pillar 2. They are certainly part of the conversation. And they have a seat at the inclusive framework at the OECD. I have not looked lately what their commitments are. I'll just note that there are other jurisdictions that some might view as tax haven jurisdictions are implementing Pillar 2, and will top off taxpayers to 15%.
So in whole, gentlemen, it sounds like we may have a tax deal at the end of 2023. We may not. And in any event, we've got to get ready for what will happen at the end of 2025 and really lay the groundwork now, both with educating congressional members and staff and making sure they understand what's important. And finally, keep watching what's going on the international stage, because that does impact why, what happens and how multinationals are taxed. And kind of covering all of this is, in my mind, is what happens with elections, and who's in charge and who runs the table, as you say. So it will certainly keep all of us tax practitioners very busy in monitoring and understanding what's happening, and certainly challenging as things that expired then, like 174, then potentially get reauthorized, so to speak. But welcome your conclusions and observations, and certainly open to any questions that people want to put in the chat box.
Nicole, if I could just add, while we're waiting for people to pose questions on the OECD piece, non-refundable tax credits are treated unfavorably under the rules. The question is, well, what are these IRA credits? And there was a real innovation in the IRA to allow for transferability. of the credits, and then some of the credits can also be refunded from the IRS. So direct pay. Question is, well, how should these be treated under Pillar 2? That issue has to be resolved with the OECD. The United States position is these are all qualified refundable credits and should be well treated under Pillar 2. But this is a political dialogue with 140 countries, and so query is how this will turn out. Can the United States secure a deal at the OECD?
Thank you, Josh. Yeah, and of course, continue to watch the IRA and what happens in any repeal or modifications as well is super important to a lot of folks. Todd or Josh, do you have any concluding statements? Exciting
None from
time.
me, other than thank you to everyone for being here.
Yeah, I mean, it is it buckle up, and we didn't get into, we spoke about legislation, but even though, you know, we think there will be tax legislation this year and potentially next year, there'll be a lot of work. There will also be guidance from Treasury, and so it's important to, you know, keep abreast of all the changes that are coming from the administration.
Excellent. Well, thank you all for your participation today. Again, feel free to reach out to any of the speakers, and feel free to check out Holland and Knight's the various client alerts it puts out on tax, and sign up to get those subscriptions. And thank you again for your time.